Okay, it's 2 p.m. and we can start with the webinar today, which will be looking at the fiscal policy responses in member states, fiscal policy responses, of course, to the corona crisis. And the issue of today is really given the health emergency and the fact that governments have been called to respond to this crisis by increasing expenditure for health purposes, of course, to respond to the emergency, but also to try to support the economy and the citizens, given that the lockdown that has been adopted in many countries in order to prevent the spread of the virus has blocked the economy. The real question is, what are the consequences for the economy? What kind of impact we can expect? And in turn, what will be the impact of this overall situation on public finances? And in order to get an idea of how the situation is developing in the different countries, we have an excellent panel of speakers. Giuseppe Pisauro is the president of Parliamentary Budget Office, which is the Italian Independent Fiscal Institution. Then Esther Gordomora, she is the director of Economic Analysis Division at the IREF, which is the Spanish Independent Fiscal Institution. And then Sander van Veldhuizen, who is a program leader at CPB, which is the Dutch Independent Fiscal Institution, and is also the president of the network of the European Independent Fiscal Institutions. And last but not least, Daniel Cross, SEP's director, who is currently at the University of Berkeley. So before we start with the question, maybe just let me tell everyone who is connected and listening to us that there is the possibility of asking questions. In order to do this, please use the button Q&A, which everyone can find at the bottom of the screen. And questions can be written from the beginning. No need to wait that we open the possibility for questions. That said, I would directly give the floor to Giuseppe to share with us his thoughts about the Italian situation, the response that the government has put in place, and how it's looking at the situation from the point of view of fiscal sustainability. Giuseppe.
Yes, thank you. As I will start with the macro prospect and what we know so far, and then go to the fiscal position. Okay, so as everybody knows, Italy entered the crisis in a position of financial vulnerability. 2019 closed with a public debt ratio around 135, the same level as 2018. This in spite of the fact that nominal deficit closed showing an improvement around 0.6 in terms of GDP. So we closed at 1.6% fiscal deficit compared with 2.2 in 2018. But the real vulnerability is, and has been for quite a long time, the weak growth. And this was also the case in 2019, 0.3% in real terms, 1.2 in nominal terms. Real growth since the Great Recession has shown a gap around 1 percentage point with respect, persistent with respect to the Eurozone average. This is the context in which the outbreak started. And as you know, the outbreak was very acute and relatively in advance relative to other Western economies in Italy. The outbreak in early March, deep dramatic shock to the economy. What we know up to now, there are, of course, at this point, quite few hard indicators of the situation, but we have something. Car registration dropped by 85% year on year. Electricity consumption in the last week of March dropped by 30% relative to the first week of the same month. Business climate, published by the National Statistical Office, lost around 10 points in manufacturing and around 20 points in services. Of course, lockdown is more severe for the service sector. And the PMI index for services was down to the historical low ever recorded. If we consider that in the first 2 weeks of March, some firms were still open, we can't expect much better for April. So using this data and other indicators, we forecast with our models a contraction in the first quarter of this year between 2.5 and 5 percentage points, and between 7 and 11 in the second quarter. This forecasts are subject to some down risk. They are based on the assumption that the negative effect on the Italian economy are limited to April, and starting from May, there is a slow opening of economic activities. This is not granted at this point. According to private analysts, an extension of lockdown of 1 month would have an economic impact of around 3 percentage points of GDP on a yearly basis. Under our assumption, we expect a rebound in the second part of the year, but of course, the strength of the recovery will depend on the timing of the release of the restrictive measures adopted so far. And an additional crucial factor is the economic policy, with the fiscal and monetary stimulus provided by the government and by the European Central Bank. But this is a very, at this point, as you see, is a very tentative forecast surrounded by a huge degree of uncertainty. So regarding the fiscal policy response, so far, the Italian government approved a first fiscal package mid-March, worth slightly more than 1% of GDP, 1.1% of GDP, 20 billion, including emergency one-off interventions under 4 chapters. The most important is strengthening and widening the scope of the existing schemes for unemployment, in particular temporary employment benefits. This was extended to employees in every productive sector, regardless of the firm size, which is a considerable widening with respect to existing schemes, complemented with an allowance for limited to the month of March for self-employed workers and seasonal workers. Then the second chapter is ensure staffing and tools to reinforce the healthcare system and the civil protection department. Then there are loan guarantees to support credit supply to firms, and finally, deferred tax payments. This is the package, and we played some role in this process. According to the Italian legislation, the package, of course, means an increase of debt, and this must be, it's linked to the activation of a national escape clause, according to the Italian constitution, and the deviation from, and this escape clause must be authorized by parliament, and we assessed this, of course, the situation, and also assessed the package I was referring before. Also, what we are doing is working together with the Ministry of Economy for the stability program that Italy, at least so far, intends to present by end of April, according to the semester, the European semester, to the European calendar. A second policy package is envisaged for mid-April, partly to fund time extensions for the interventions enacted in March. Its size might be around 2% of GDP. So we have 1 + 2, 3% of GDP of new measures. One should add, of course, to these two packages, the effect of automatic stabilizers that will involve substantial loss of tax revenues and increasing expenditure for the existing schemes of income support. All this will clearly imply a substantial worsening of deficit beyond what was experienced in 2009, when the Italian public deficit was slightly higher than 5%. And was the only year when Italy has shown in the last 3 decades a primary deficit. For all the last 30 years, we have shown always primary surpluses. Debt to GDP ratio will correspondingly reach a level experienced only in war times. Then the crucial question, financial capacity to cope with this crisis. It will depend, of course, at this stage it's very difficult to make a clear statement about this. Depends on the macro context, depends on the size of fiscal packages and so on. But what we can say with some degree of confidence that the crucial element will be the absence of tensions in the sovereign debt markets. And so far, this should be ensured by the European Central Bank programs, the 2 programs, including the new one, the PEPP, of purchases of government bonds. It will also depend, I'm going to close, on the response from the European Union. Of course, there is a wide discussion underway, let's say, and passionate discussion also. But if you so far do it by yourself approach has been followed. General waiver of fiscal rules, and everybody does what he can, supplemented by European Central Bank umbrella. I will elaborate in the second round on this, but just to conclude, I think that this approach is not sufficient, and is not sufficient not only for Italy. If we want to learn a lesson from the Great Recession, Italy entered it with a debt ratio slightly lower than 100% of GDP. The level where today other countries, for example, Spain, France, are today. And in that situation was not able to operate any sizable fiscal stimulus package, and ended up, as we've seen, some 10 years later, with a debt ratio at 135. Of course, one might argue that the situation is better than 10 years ago, because now we have many instruments to cope with this crisis, mainly the ECB and the QE by ECB. But we may also think that the situation will be worse, because by any indicators, as far as we know now, this crisis will be much deeper, much more acute than the one we experienced at the beginning of the Great Recession. Thank you.
Thank you very much, Giuseppe, for illustrating in such a clear way the situation in Italy, despite the uncertainties. I will now give the floor to the word to Esther to illustrate how the situation is in Spain.
Thank you very much, Cynthia, and thanks a lot for inviting me to this seminar. In my first intervention, I would like to address what is being the impact, the significant impact that the corona crisis is having in the Spanish economy, and also what has been the fiscal response, what has been done, and what needs to be done in the future. And I leave for my second intervention some views on how I think that our fiscal framework needs to adapt to this extreme situation. Well, regarding the Spanish economic situation, as you know, we have been these last weeks at the center of the pandemic. The situation has been dramatic, and fortunately, during the last few days, we are beginning to see a decline in the number of new cases and in the number of deaths. So fortunately, we're seeing light at the end of the tunnel. But in any case, the impact of the measures implemented to contain the virus the economic impact is being dramatic. The government has introduced some strong restrictions to mobility to contain the spread of the virus, and also during the first weeks, stop in the activity of some sectors, mainly restaurants, hotels, and tourism. But during the last 2 weeks, the government has banned all non-essential activities. So this is going to have a significant effect on economic activities. It's practically a complete stop of activity. So we have been at IREF, we have been monitoring very closely the situation in order to provide a timely assessment of economic impact. And we have been preparing some macroeconomic scenarios, but I have to admit that they have changed dramatically during the last, just only in the last 2 weeks to reflect the severity of the crisis. Now we have some estimates that suggest very uncertain, of course, as Giuseppe has mentioned before, for Italy. We have some estimates that suggest that perhaps the decline in GDP in the case of the Spanish economy in 2020 will be close to 8-10%, with respect to the baseline scenario, to our previous baseline scenario, and before taking into account the impact of all the fiscal measures implemented, which could offset very partially this significant fall. It's a dramatic fall never seen before in times of our democracy. So we are very concerned about that. Of course, these estimates are surrounded by a lot of uncertainty. In the case of Italy, we don't have still enough information to do a better estimate, but we are preparing some scenarios. And looking to the future, this is for the year 2020, but looking to the future, we see that the Spanish economy, we see, of course, a rebound, as in the case of Italy, but we see that our recovery will be complicated by some factors. The first one is that we are seeing a significant fall in unemployment. Despite this time, Spanish firms are using more extensively ERTES, which is a kind of temporary suspension of the employment relationship. Despite this fact, we are seeing a huge and dramatic increase in unemployment. Just in the last 15 days of March, the number of Social Security affiliations declined by the same amount that during the worst 5 months of the global financial crisis. So it's a very dramatic increase in unemployment, and this will slow probably the recovery if we don't implement the appropriate measures. And also another factor that could complicate the recovery in the case of the Spanish economy is the high proportion of services in our productive structure. We depend a lot, we rely a lot on tourism sector and restaurants. And this type of services are going to be the last to recover, because well, consumers may fear the risk of infection, and also because perhaps in the future we will have to face some kind of social distancing measures. So we see the recovery with a lot of risk, and also at the global level. Well, as soon as the crisis is spreading to a lot of countries, to the whole world, within that the negative impact on world trade will be very significant. Spain is a very open economy, so we see also risks from on this side, and also perhaps there could be some confidence effects, some business closures. So the situation is very pessimistic. In this situation, it's totally clear that we need a strong fiscal response, and the government has implemented actions in a lot of fronts. I'm not going. The composition is very similar to the composition of fiscal measures in Italy. They include support to the income of the most vulnerable groups. They include also a significant provision of liquidity and guarantees to firms to help them to survive the crisis. As I mentioned, the composition is very similar to that of the Italian economy, so I'm not going to describe all the measures. I don't see also the necessity to debate if this fiscal response is consistent or not with our framework. Fortunately, it is. It's clear that it is. Fortunately, the European and the national fiscal frameworks include a general clauses mentioned by Giuseppe, so they provide enough flexibility to respond to this extreme crisis. And what I find more important, perhaps, is to question if this fiscal response is enough, is sufficient, and also if it is sustainable. And with regard to the size, I would like to stress that, well, unfortunately, the crisis so far had hit harder the countries with less fiscal space. So when we compare the Spanish fiscal response with the response of Germany or the Netherlands, we see that the direct increase in spending is lower in our case. And of course, this reflects that, countries with lower deficits and lower debts were in a strongest position to respond to the crisis. And this is something that we have to internalize for the future. We have to internalize it into our ADN. We need to build, this is one lesson we don't forget, we need to build fiscal buffers in order to, during good times, in order to fight the crisis that I'm sure will come. So, but this time is too late. So I would like to address also the question of sustainability, and we have to admit that the crisis is going to increase significantly the levels of debt and deficits, and this will be the result mainly of the decline in economic activity, not only the result of fiscal measures. But in any case, I think that the measures are necessary. If we don't win the battle against the virus or the social crisis, perhaps the sustainability will be the smaller of our problems. So I consider that they are necessary. The response is adequate, but we cannot forget the lessons learned during the last crisis. We know that sovereign debt markets are exposed to multiple equilibria. We know that investors can change very quickly their assessment about how sustainable is a country's debt. So I think that we need to do more, and not at the country level. We need to do more at the European level. And in particular, I think that to avoid the bad equilibrium of a sovereign debt crisis, we need to explore the possibility of introducing corona bonds. I think is the best instrument to fight and to eliminate or mitigate the possibility of a debt crisis. And I'm not talking about Eurobonds, the permanent instruments. I'm just talking about the one-off instrument to fight this crisis. But I think that apart from the ECB response, this element is totally necessary. So I will stop here.
Many thanks, Esther. Before I move to Sander, there was a question about a clarification on the point you made. Can you just repeat what is your first estimate of the downturn in Spain?
Close to 8-10%. But this estimate is calculated before introducing or factoring in the fiscal measures. So we will have to do some analysis.
Okay, thanks.
Excuse me, Esther. 8
Yes.
on a year for the year or for this term?
8-10% of GDP fall.
Okay.
Okay, so we heard about the very dramatic situation in Italy and Spain, who are the two countries where the corona crisis started as a health crisis, and the two countries with the highest number of contagious people and deaths. We're now moving to the north, to the Netherlands, where the lockdown started later on. Sander, what is the situation in the Netherlands, and how has the government reacted to the crisis?
Yeah, thanks. Thanks for having me in this webinar. Very nice to be here and to talk a bit about the current Dutch situation. So for us, this started the beginning of March. Then the first people having the coronavirus were identified in the Netherlands, and exactly at that time, so March 3, we published our forecast for 2020 and 2021. And at that time, we forecasted a GDP growth for this year of 1.4%, and we predicted a budget balance of 1.1% of GDP, and a GDP to debt ratio, a debt to GDP ratio of 46%. So that was roughly 4 weeks ago, and since then a lot has changed, of course. So we also saw in the Netherlands that the outbreak of the virus increased rapidly. So we have been in a kind of what our government calls a intelligent lockdown since 2 weeks or 2.5 weeks, basically. Which, well, intelligent lockdown means that you cannot go outside, you have to stay at home, but you're still free to go outside, but not with as many people as you want. So I can go and do some groceries, and that's basically it. And I can go outside running, and I can go visit my parents, but you're supposed to work from home. Nonetheless, it means that parts of the economy face, let's say, closings of businesses. So particularly small businesses are closed, the restaurants are closed, cafes are closed, etc. So in a sense, we are a bit behind Italy and Spain. So what we advise the government to do, so the moment the lockdown was introduced, there was a big debate about what the policy response should be. The thing that was the common idea in the Netherlands was that there should be a overreaction in terms of policy response. So you should think big, not small. So that's, I think, what the Dutch government has done. So there is a package that is for at least 3 months ahead. There is spending of 2-point-something% GDP. It depends a bit how you measure it. So if you measure the direct budgetary impact, it is 2% of GDP. If you count in the automatic stabilization and the tax deferrals, then it adds to a couple of percent of GDP more. We have made some scenarios on that. So the minute the government came up with this package, so the 16 billion euros package, we started to develop a few scenarios based on the length of the lockdown. So we have made 4 scenarios where the length of the lockdown varies from 3 months up to a year. And within the scenarios, we also assumed that the measures that have been taken now, they are being extended when the lockdown is being extended as well. So in the worst case scenario, a lockdown of a year, then the policy response that we have now will be extended for a year. The good news for the Dutch economy is that, in principle, the Dutch government should be able to carry this burden. So what we see in the scenarios is in the let's say the optimistic scenario, that's a 3-month lockdown. Annual GDP, real GDP growth will drop from a growth of 1.4% to a shrink of 1.2% in 2020. In the worst case scenario, that will drop down to minus 7.7% GDP, minus 7% growth. In that case, the budget balance will go to minus 10% of GDP in the worst case scenario. In the worst, let's say in the best case, the budget balance will drop to minus 1.something%. The debt, so that's the interesting thing. So in all scenarios, the debt is not increasing debt dramatically. So in the best case scenarios, it's staying under the 60% of Maastricht Treaty. In the worst case scenario, it just drops a little over the 60% of Maastricht. So that means that for us, for the Netherlands, this is perfectly doable. We can handle this for a year or even longer. So we haven't exercised any scenarios that the lockdown will take like 2 years, but I think that we can also manage. Well, it would be possible to manage it, probably. The question is, the thing that I didn't extend on yet is what are these measures that we have taken? So basically, the policy package consists of 2 main elements. So the first element is that the first element consists of allowances for businesses and employees to compensate for income loss. The biggest chunk of that is an extension of the existing working time reduction arrangements that were already in place. So we extended that. And it has been extended to so for companies that face a 20% turnover loss or more, then the government will take up 90% of the salaries of the employees, as long as you don't dismiss any personnel. So that's for the first 3 months, that will cost around 10 billion euros. So that's almost 1.3, 1.4% of GDP. Then we have income support for the self-employed. That's around 2 billion euros, 1.5 billion euros, something like that for the first 3 months. And that will, the longer it takes, the more expensive this will become. And then there is an emergency desk for firms that have been closed that had to close due to the lockdown measures. And that emergency desk will give you immediately 4,000 euros to cover for the cost that you have to make immediately. For this, basically for very small firms and restaurants, etc. The second part of the policy package is basically guarantees and tax deferrals. So that's around the direct impact on the budget is now 4 billion euros. The only thing that is difficult with the tax deferrals is how much you are going to lose in the end. That's something that's hard to estimate. What we know from the crisis in 2008 is that if you look to the carry backward of losses, so that can run up very fastly. So we know from 2008 or 2009 that the carry back of losses totaled more than 1% of GDP in 2009, and that shock was smaller than the shock that we're facing now. So this could be, I mean, this could be a bit more expensive than roughly 10 years ago. So that was also included in the scenarios. Yeah, so that's basically, I think, what we have done so far in the Netherlands. And what I understood is that today or tomorrow there's going to be an additional package on loan guarantees. That's not included in the scenarios that we have exercised so far. So we are going to update the scenarios within 2 months, I think, when there are going to be additional measures. And then we also probably know what's going to happen on the European level. So that's basically what we have been doing in the Netherlands for the past, let's say, 2 to 3 weeks. And I'll stop here for now.
Thanks very much, Sander. So the situation looks quite different. Huh? North, south, it's It's of course a matter of levels of debts, but maybe also intensity of the crisis. This, we need to see, because whether this actually can be kept under control at this stage or will keep increasing. I'm now turning to Daniel. Both Giuseppe and Esther made reference to the need to do something at European level. Daniel, what's your take on this point?
Yeah, Tricia, thanks. I think the difference in perspective is quite striking. I think not only in terms of actually the expected loss of GDP, but also, of course, in terms of the fiscal space which is available going into the crisis. And I think the general conclusion is that while many people say this is a symmetric shock, it is asymmetric in the sense that it hits the weakest hardest. So in that sense, the outcome, I think, is quite asymmetric. We heard from the Dutch, okay, even if it lasts for a year, we can handle it, right? And we heard from both Spain and Italy that even in a medium scenario, you're getting to the limits of debt sustainability. So therefore, the question is, what can one do at the European level? And here, as you know, perhaps my take is that this is not the time to provide additional credit. Spain, but even more Italy, already have too much debt, and giving these countries more credit, even at a somewhat lower interest rate, wouldn't really help them a lot. So my plea would be that this is a time when one should think about transfers. So let me perhaps make the credit versus transfers case a bit more precise. Many people have talked about the ESM, and let me not talk about the conditionality, which is really neither here nor there, because everybody knows that there would be no conditionality in year 1 or 2, but presumably if you get a 10-year loan from the ESM, you cannot expect to have zero conditionality for 10 years, right? That can be discussed. But the key point is that the ESM loan would make the existing debt of Italy or Spain junior, because ESM loans are senior, and therefore probably the cost of refinancing the existing debt of Italy would go up. Now, how about Eurobonds? Many people have the impression that if something is a liability of the EU, it's no longer debt. It has disappeared magically. But that's not true. Even if you had Eurobonds today or Corona bonds to finance this part of this, Italy and Spain would still have to contribute their part to servicing these bonds. So it's not that this is free money. It's just it doesn't appear on national debt statistics, but it is still an obligation which Italy or Spain would have to service. And again, an obligation which presumably would be senior to the existing debt. That is why I must say I don't understand the insistence of the Spanish and Italian other leaders to say we need Eurobonds, because that doesn't, in my view at least, solve the problem. So therefore, my idea was to use the EU budget. Here, the problem is that the EU budget in principle cannot be in deficit. And this is in the treaty, and it's difficult to change really in a month or two. And we need action very quickly. However, what could be done is to say that Italy or Spain do not have to pay their contributions to the budget over the next MFF. And that would make room for about 1% of GDP. Ideally, 7 years would be 7% of GDP, not of a loan, but of a less money spent by the Italian government. So basically, essentially a transfer. And I think that is what is needed right now. The Italian budget needs to be have some more room for maneuver. And even if it doesn't come immediately today, I think financial market would appreciate that a lot. because, as I said, it would not make the existing Italian or Spanish debt subordinate to new obligations. So, to summarize, the crisis, in my view, the impact of the crisis, at least, is not symmetric. It's very asymmetric. And secondly, this is not a time, especially for highly indebted countries, to give them cheap credit, but to make a transfer. Even if the transfer is smaller than the credits they could be able to get, because additional debt is not what either Italy or Spain need at this point.
Thanks very much, Daniel. I would like to ask Giuseppe and Esther whether you share the point of Daniel about Corona bonds or Euro bonds for this specific case, and the risk that they carry for Italy and Spain in this case.
Okay, I will start. Esther, you want? Okay. Yeah. Oh, there is, of course, if Corona bonds are in the market, the risk is clearly present, would be clearly present. Let me start with what would be this is my personal opinion, it's not QBO opinion. We didn't discuss that. My first best solution. First best would be something along some proposal. There's been also in your last webinar by Paul de Grove, something which involves issuing a perpetuity or a very long bond, financing all European countries, all the need arising from this crisis, and ending in the balance sheet of European Central Bank. So an exceptional one-off monetization of the debt. This would have an economic risk, inflation, which at this point is not really an important risk. Would have, I understand, would have a very important political risk involving independence of the central bank. But when it's made clear that this is one-off, endpoints of GDP for each country without any sharing of risk, any sharing of any mutualization of debt, just to finance the effect of this crisis, the direct effect of this crisis. What I don't understand in the proposal of Daniel, Daniel says, okay, let's make transfers, but what kind of size? Maybe I missed it. What size of these transfers? Because what we need is something quite large. So that's all.
Esther, would you like to add something?
Yes, thank you. Well, I think that the main advantage of Corona bonds is that they don't zoom to national debt. They are not really national debt. Of course, we will have to contribute to pay the loan and to pay the cost. But if it's a long-term emission, a long-term issue, I don't see any significant problem because it could not be Italian or Spanish debt. And just a question to Daniel. I think that, of course, transfers could be the best instrument, but do you think that transfers are more feasible than loans? I don't really think so. I think that it would be very difficult, and also perhaps the European Union budget is not, the size of the European Union budget is not enough to support these transfers, because I think that the cost of the crisis is going to be very, very significant, very extreme, So I don't think that the system of transfer would be better than the corona bonds idea.
My point was more about the not about the political feasibility, but about the economics of it. That I have the feeling that both Italy and Spain are asking for something which in the end will not help them a lot. I totally disagree that Eurobonds, just because you don't see them in the national debt statistics, are not debt, right? Especially if they're once off and supposed to be paid. On the political feasibility, maybe we should ask our Dutch panelist.
Yeah, Sander, what is, so I've been discussing Eurobonds / Corona bonds. Daniel mentioned transfers. There was, Daniel at the beginning also mentioned the ESM and maybe getting rid of conditionality. Is any of these options debated in the Netherlands, and do you think that any of them would be acceptable politically?
Yeah, so that's always a difficult question. So what is politically feasible and what is politically not feasible? So what you typically, so if I go back a bit in time, so that's what I also wanted to say in response to what Daniel said, is that about a year ago, we had this debate about the central fiscal capacity in Europe. So I wrote a piece on that, and the analysis that Daniel was saying right now is exactly what we analyzed back then. So if you have a, let's say, asymmetric shock, then you should think of an insurance mechanism, then transfers. If you have a very big shock, then transfers are better than giving some extra credit lines or adding extra debt. So I fully agree with that. So that was also, at that time, a year ago, in the Netherlands, a very difficult debate. What you see now is, I think, is that debate is a bit, so what we see now, what Dutch politicians now understand is that you have to do something, and that giving, let's say, extra credit lines or Eurobonds is not the solution for, that only adds debt to highly indebted countries. So that cannot be a solution. So that's, I think they are mentally making the step that you have to do something in terms of transfers, as we would do in a, let's say, regular insurance problem, right? That's just the economics of it. So I think we're getting closer to a solution that would include something like transfers. But what the political outcome is going to be, so that's hard to predict. It's always hard to predict, I would say. We're gonna know maybe today or this afternoon, I believe, that they're gonna have a meeting again. So we'll see. But if you look to what our contribution in, let's say, the contribution of the CPB in a national debate is, that we think that transfers are a better solution than giving extra credit lines.
Maybe I want to pick up on a question which has been asked by one of the participants. Basically said we should maybe distinguish what is the size, what are the amounts we're talking about when we have in mind Corona bonds, which, for instance, could be monetized by the ECB, and what is the amounts we are talking about when we talk about transfers. Because this, I think this point was raised also by Esther. What are the potential amounts one can have in mind and in these two different debates?
Who do you want to answer?
Daniel, do you have an idea?
Yeah, I mean, it's quite clear that transfers will have a smaller headline number than loans, right? For loans, you can have easily headline numbers of hundreds of billions. But as I argued before, and it seems that Sanders agrees, a loan from the ESM, even if it's 400 billion, is not really worth a lot because it subordinates the existing debt. On Eurobonds, the Corona bonds, can I remind people that we had a big or long discussion about Eurobonds 10 years ago, about the blue bonds and red bonds proposal. And the proponents of that proposal said the idea of having these two types of bonds, European ones and national ones, which are not guaranteed, is to make the national ones more expensive, to provide incentives, right, for countries to behave better. So it was explicitly recognized that Eurobonds will subordinate the national debt and make it more expensive. And therefore, I would say better to have a small transfer than a large credit.
Daniel, let me follow up on this. So I think that in 2018, if I'm not mistaken, Italy's contribution to the budget was about 14 billion, okay? So that would be more or less the sort of annual amount.
Correct, exactly.
Okay,
Yeah.
now, if the intervention of the government is such that actually deficit increase by several let's say, much larger amount. Let me put it this way. Can Italy incur in a problem of liquidity on the markets, or end up in a situation where the interest rates become really large, so that this transfer is actually not doing enough? I mean, your point is it's about long-term sustainability versus which something you have in mind, and not necessarily the short-term needs, if I understand correctly. How can we strike these different views?
That is always a problem, right? Now here I would say actually there's a difference between 2008-9 and now, because 2008-9 was really to a large extent a crisis of liquidity, right? Here, of course, we had a crisis of liquidity 1 month, perhaps another month, but then, so I would say the crisis of liquidity, if there is an additional liquidity issue, that is legitimate target for the ECB, right? Liquidity is the central bank, and the central bank can always print enough money to provide enough liquidity. But liquidity crises don't arise out of thin air. I know everybody says there's a dual equilibrium, but the Dutch are not subject to dual equilibrium because they have no debt, right? You have dual equilibria when there's at least some doubt about the ability of the government to repay at some point in the future. And the better, the stronger the position of the government in the long run, in a long run perspective, the less likely a liquidity problem becomes. Therefore, I would argue that you cannot exclude a liquidity problem, but it becomes somewhat less likely if there is a transfer. If you give only credit, then people can make the calculation that over the next 10 years, the position of the country will not really improve, that the bonds which they hold have become junior, and therefore the liquidity problem becomes, in my view, more likely. So it's not 0-1, right? You can exclude liquidity problems, but I would argue that they become a little bit less likely under my approach than under the approach of just giving credit.
Giuseppe Esther, would you like to react to this?
Yeah, of course, very much depends on the sides of. I understand that the idea of transfers would involve a lower amount. I don't understand how much lower. The point is that I agree with what Daniel says about Eurobonds. I think that it's unfortunate that we are talking about Eurobonds now, because this is not the same discussion that we had 2 years ago or last year. It's a completely different discussion. It's about responding collectively without any mutualization and without any sharing, collectively to this particular situation. And if you look at it from a longer term perspective, the essential point is to avoid destruction of productive capacity. And to avoid destruction of productive capacity under worst scenarios would involve a substantial amount of liquidity. Now, this is the basic one, because if you say we decide for a transfers from northern countries to southern countries around 2% of GDP. Would be that sufficient to avoid destruction of productive capacity? That is the point. And the idea of a common response without, I insist, any sharing, any mutualization, is that in a very interconnected area as the euro area, this would advantage everyone. There is no cost for nobody.
Can I ask something, Cinzia? After Esther?
Thank you. Thank you very much. Well, for me, it's very difficult to know which is the size, the appropriate size of transfer or a corona bond. But for me, the key question is that we know that the euro area governance is still incomplete, and that makes are vulnerable to sudden changes in investors' confidence. And if we face a new, well, if there is a sovereign debt crisis, perhaps what could be the size of the amount we need to put on the table? Perhaps the ECB knows that is whatever it takes, but for me it's very difficult to know what could be the size. And also I think that the ECB has done a lot of things. It has provided a lot of relief, but it has limits, has legal limits and political limits to its actions. So I think that in the euro area we need some other instruments to fight with this type of shocks, common shocks that have asymmetric effects. Perhaps in the future we'll need to think about a fiscal capacity for the euro area, but this time it's not here. So so we need to think about something, and perhaps I think that corona bonds is just only a specific emission issue for this problem would be a good instrument.
Daniel?
Actually, I wanted to get away from the corona bonds because I was struck when Giuseppe started, because one of the first points was the real problem of Italy was the low growth rate. And that's different, of course, from Spain, where the growth rate has been, let's say, a bit higher, where the debt accumulation didn't come from that point. But let me come to the low growth rate for 20 years, and Giuseppe emphasized that. Now, would that not make some Schumpeterian destruction of capacity a good thing for Italy in the long run? Like in the French, when they say reculer pour mieux sauter, that perhaps you have to destroy some of the old capacity which has been so sclerotic, and that maybe then liberates the countries and resources to engage on a more productive path, which would have higher growth rates. And I would take any time a sharper recession today if I could increase the growth rate of Italy even by only 0.5 percentage point. Giuseppe.
Oh, I like Schumpeterian creative destruction, but this is not, in this case, is not what Schumpeter had in mind. This is not a destruction caused by, I mean, being inefficient or being in a declining sector and so on. This is just random, caused by a, say, 3 months, 4 months, 6 months stop of your activity. If we follow it, we will say that all the tourism sector will be destroyed. Okay, is that creative, Daniel?
It doesn't have to be, no, that the tourist sector is that the strongest in each sector will survive, right? Even if I make the comparison, I mean, the tourism sector in Spain has been so much more dynamic than in Italy. And I suspect that this is also because in Italy, a lot of productive structures in tourism and elsewhere, which were barely survivable, right, have been kept alive. And a crisis like this is not random. It will push the weakest, which were borderline above the abyss. They will disappear. That is, of course, very difficult to accept for society. But then you liberate resources to engage in much more productive activity. So it's not random. It pushes, as I said, the weakest out of the market.
Okay, we have reached our time limit, but I would just quickly put on the table two very last questions very shortly, because not many were addressed. The first one is going back to Corona. Is the idea of Corona bonds and transfer, the ideas of Corona bonds and transfer mutually exclusive, or actually they could be considered together? And the second one, which is addressed to our guest from independent fiscal institutions, how your institution is going to go about that given the current circumstances. So it's really about the role of independent fiscal institution in terms of watchdog of fiscal sustainability. Is the crisis having an impact on the role of your institution? Maybe 1 minute each for all of you. Maybe I go on the other way around. Sander, I start with you quickly.
Quickly, so within 1 minute. So I think that Corona bonds and transfers mutually, I think they were mutually exclusive because of all the things that Daniel has been saying. I think also the way we have been thinking about it in the past. So maybe it's more, the second question, is our role changing right now? So I think it is, so when there is a crisis, and that was also the case 10 years ago when most of the other countries didn't have an IFI as they have today, but we already exist since 1945. So we know from experience when there's a crisis, then everybody is looking at you, and that's exactly what is happening today again. So all politicians, all policymakers, they are looking at us right now. So what is the current fiscal situation? How much fiscal space is there? Not that that is really a problem in the Netherlands, but still you're becoming more important in the political process. And at the same time, your job is way more difficult than in normal times because there is hardly any information. Let's say hardly any hard information. So that's the squeeze where you're in.
Okay.
That's it. That's within 1 minute, right?
Good.
Thanks a lot. Well, today's of Corona bonds or transfers, I think that transfers are not realistic for this time, but it could be a good idea to think about the possibility to build a permanent instrument, a fiscal capacity instrument to fight with this type of shocks. And today's show of FIFIs, well, I think that now perhaps it's better if I share with you some of my views on how our work, our fiscal frameworks need to adapt to this situation. Now the priority is to support the economy, but as soon as the crisis, the health crisis and the economic crisis is over, I think that governments need to be very quick to implement very quickly medium-term budgetary plans to build fiscal buffers and to reduce the levels of debt. And I think that our institutions could contribute a lot to this issue. I think it's a very, very challenging task because, well, now we need to introduce new elements in the loan list that could have. We need to introduce the need to fight with this type, the risk of the possibility to have this type of health crisis in the future, and this has to loan list, including climate change, aging. So it could be a very challenging task. But we need to think about what could be the most appropriate phase of adjustment in the future. And to do so, I think that we need to introduce some changes in our fiscal framework. We need to think more in the long term, in the sustainability, not in the short term. We need to forget to use these figures about as output gap and structural balances, because who on earth is going to be able to calculate output gap of fiscal structural balances in this situation after these extreme shocks? So we need to forget this type of instruments, and we need to rely more on observable variables. Perhaps I think that the idea of introducing this proposal of an expenditure rule with a long-term objectives in terms of debt and an intermediate instrument in terms of expenditure could be a good idea to face this situation.
Giuseppe?
Yes, coronavirus plus ECB and transfers are mutually exclusive. Yeah, I suppose. About our role, I don't know. I think that in the near future, I mean, at least in the short term, we will be less watchdogs, because I understand that this year and the next one, fiscal rules will not be prominent, but then it will become more difficult for us to work. And we should contribute, in my view, to a better informed debate. After all, the first Fiscal Council, after the Dutch one, of course, but in more recent decades, CBO started in an environment without fiscal rules, but its role was to provide non-partisan analysis. And I think that this is, in a nutshell, our real role, and would be our role in the next future. And then okay, hopefully we will come back to the old world, I don't know, but for a while at least. Thank you.
Thanks very much. Daniel, the last word for you. Can you unmute? Can you unmute yourself?
Thanks. Sorry. It will be both very long and very short to get back to normal times. I think if we're sitting here 1 year from now, which historically is very short, many countries will have overcome the crisis and will be back to normal. And then unfortunately, you will have those who started the crisis very weak position, and who might actually have a very tough period, longer period ahead of them. And the question is, how can we shorten that period? How can we help them right now? And I think that's what needs to be decided actually today in the ECOFIN. I would say it's not totally exclusive to give some credits and to give some transfers, but I think our finance minister should look more at the economics than at the short-term political waving of solidarity. And from an economic point of view, I would prefer transfers to credits.
Okay, thanks very much. We went a bit over time, so now it's really the moment to close. Thank you very much to all of you for your inputs. Thanks very much to all the attendees. There were quite some questions which we didn't have the time to answer. I will share them with you. There are some interesting thoughts to share. And good afternoon to everyone. Bye.
Bye.
Okay, thank you. Bye.